this video, we're going to take a look at section 8.2 on income tax. So this is definitely not my area of expertise. So we'll kind of just read through this together and figure it out as we go. We'll just try to read the definitions and the formulas and then apply those to the problems that we are asked to do. So this is by no means, I'm not giving financial advice or anything like that. So income tax is a percentage of your income collected by the government to fund its services and programs. There can be different types of income tax depending on where you live. There is a federal income tax, which affects everybody that lives within the country. And then some states will have a state income tax. Kansas, for example, has a state income tax. And so with my paycheck, I will have money withheld for federal income tax and money withheld for state income tax. So the federal income tax withheld from my paycheck goes to the federal government, and the state income tax withheld from my paycheck goes to the state of Kansas. And in both cases, it's to fund services and programs. So I imagine there might be some limitations on what certain money could be spent on. For example, the state government pays for roads and things like that, but I don't think they use your income tax to pay for roads. They presumably use your vehicle taxes to pay for roads and gas. So when you get gas at the gas pump, there are taxes on top of the gas prices that you pay, and some of that is supposed to fund the maintenance of roads, from my understanding. So income tax maybe can't be used for that purpose, but it's used for other social programs, voting, because hosting a vote, having polls open, things like that, all that costs money. Schools, things of that nature will be funded by income tax. So percent and income tax. So to calculate your income tax, first you would have to determine your adjusted gross income. So the word gross here is kind of an old use of the word. It just means total. So gross income would be your total income before any adjustments are made to it, before any money is taken for whatever purposes. So with my paycheck, again, just speaking personally, I have a certain gross income. I guess I feel like I shouldn't say it, but I'm a public employee. So if you were so inclined, you could look up my salary and find out how much I'm making each month. And then from that, a lot of money is taken, for example, for health insurance, federal income tax, state income tax. Social Security is another thing that they garnish your wages for, which will hopefully be there when I retire here in 15 or 20 years, whenever that happens. Medicare, Medicaid is another tax that's taken out, or a fee, or whatever you want to call it, from my paycheck. I have another retirement fund that some money goes to. I'm trying to think what else. So you take all that stuff out, and then my net paycheck is a lot smaller than my gross paycheck, what I technically make versus what I actually see in my bank account. So that's just the nature of living in this day and age. Is you'll have a certain amount that you're paid, but how much of that you actually see could be quite different. Here we're talking about calculating adjusted gross income. So it's still a gross income. It's still a total of some sort, but we adjust for certain tax-deferred things. Now, what tax-deferred means is it's something that you get to pay towards that's not taxed. So that gets removed first before the taxes are calculated. I don't think I personally benefit from anything like that, but I do know I have the option of having a health savings account. Some retirement, maybe I do benefit from that, like with some of my retirement stuff, because I have there's Social Security, which is a federally run thing, but I also have CAPERS, which is a state-run pension plan, and that might be tax deferred. So they might take my CAPERS money out of my paycheck before calculating taxes. So the money that goes to CAPERS is untaxed money. Now, what ends up happening in those cases is you get the benefit of not having it taxed when you pay into it, but generally those kind of deals you'll just pay that tax later when you withdraw from it, right? So when I retire and I start drawing on my pension, then I will have to pay the taxes that I didn't pay when I paid into my pension, right? So that would be tax deferred. It's something that you put money toward without that money being taxed. You don't pay taxes on that money at that time anyways, right? And then so once you take out those adjustments, so let's see here, okay, then you can calculate the tax that you will owe. I'm sorry, I guess no, we're not even there yet. So again, sorry, not an expert on this stuff. I'm kind of reading it along with you guys. Then we can calculate our taxable income by taking the adjusted gross income and subtracting out exemptions and deductions. So this is kind of what you do when you file your taxes. So the exemptions and deductions generally don't happen paycheck to paycheck. They will take out a certain amount of tax without that consideration. And if they take out too much tax, then when you file your taxes and you let them know what your exemptions and deductions are, they will give you a refund for if they took out too much, right? Which is generally what happens for me, because I have 4 kids. You get tax deductions, you get child tax credits. That's a different thing. The tax credits are different. Excuse me. But you also get like deductions for dependents. And so I have 4 dependents, which means I don't have to pay as much tax. With my federal income tax, I generally get a pretty nice refund. And I think I'll continue to get a nice refund until my kids are adults and I can no longer claim them on my taxes. What was I going to say? With my state income tax, I actually end up owing money. So they take out a certain amount from every paycheck, but it's never enough to cover the amount they say that I owe in state income taxes. So I end up having to pay $200 or $300 every year. So, of course, what I do is I file my federal income tax first, get the refund from that, and then use part of that refund to pay what I owe on state income tax, because I always end up owing a couple $100. So when I file my federal taxes, I let them know I have 4 kids. I get a deduction from that. Now, with federal income tax, I generally take the standard deduction. And so that is sort of a baseline of however much money you made, you can subtract this much off of it, and we won't tax you on that part of it. I can't remember how much I want to say it's generally, I can't remember how much it is. I want to say 15,000 or something to that effect. I could be wrong on that though. However, depending on your financial situation, you might benefit from taking an itemized deduction, and you get deductions for things like mortgage, property tax that you pay, mortgage interest that you pay, health cost if you had a particular year where you had a large number of doctor bills. I think you can use those as deductions. And so generally I explore that option of, well, what items could I deduce? But it never adds up to as much as the standard deduction. So I generally just take what's called the standard deduction. So you take your adjusted gross income minus those deductions and exemptions. I want to say kids count as part of that too, but I can't remember if kids count as a deduction or an exemption. And whatever you're left with becomes your taxable income. And then the income tax you pay, and this is step 3, is however much you calculate that you owe in tax, the tax computation, minus any tax credits, which again can become negative. So for me, with again having 4 kids, you get a child tax credit. You can get I can't remember what it's called, like a working credit, depending on how much you make. So if you make too much, certain credits become unavailable. So for example, here it says may include up to $1,000 per child, the cost of childcare, adoption credits. This year, actually, I don't know if it was a good idea, but I was able to get a loan to get solar panels on my roof, and there is a solar credit that I can claim on my taxes, so that's something I'll have to figure out how to do when I file my taxes at the end of this year, and that would count as a tax credit. And so if you end up with a negative amount here, right, if you take your however much taxes you owe, minus all those credits, you could end up with a negative amount, which means you're going to get a refund. You're going to get more money back than because you're owed more money than you. How do I say this? The government owes you more money than you owe the government, right? So that is a rough idea of how your tax is determined. There are different tax brackets, which makes it even more complicated. So for different income levels, they break the taxes down in different ways. And again, there's just all these different loopholes, all these different programs. So actually determining your taxes and filing can be pretty complex. This is a pretty simplified version of this, of how it might work. But in practice, it tends to be a little bit more complicated than this. All right. So let's see if we have an example here, and we'll see if we can figure this out together. All right. So a single man earned wages of $46,500. So there's another wrinkle when it comes to determining your taxes. You can file single. You can file jointly. So married. You can, if you're married, like I am, you can file married single. Like I'll file my own taxes. My wife file her own taxes. You can do married filing jointly, and there's other options there. And so you have to consider, well, which one's going to be more beneficial for me? Should I file individually, my wife and I separately, or should we file together? There's also head of household. I think there's other options as well, and it can be kind of hard to figure out what option is best for you. A single man earned wages of $46,500, received $1,850 in interest from a savings account, received $15,000 in winnings on a television game show, which gets taxed, and contributed $2,300 to a tax-deferred savings plan. So that $2,300 was taken out of their paycheck and put into a savings plan without being taxed. So it gets exempt from having any taxes applied to it at all. Now, with the winnings, this is kind of interesting. I don't know if it has this here. Does it say anything about how much you pay for that? No. In general, winnings, like lottery winnings or game show winnings, will not get taxed at the same rate as income. It gets taxed at a much higher rate. So, in general, my understanding is if you have a windfall, like you win the lottery or something like that, you tend to lose half of your winnings. So if you won $15,000 on a game show, you probably owe about $7,500 in taxes on that. It's very heavily taxed. There are cases where, like, let's say you go on Wheel of Fortune and you win a car on that. Well, then they figure out, well, the value of this car is $30,000 or whatever. And based on that value, you owe taxes of 50% on that. You have to pay $15,000 for having won that car. And for a lot of people, they can't afford that, right? They want the car, but they don't have $15,000 to pay on the taxes for the car that they won. So oftentimes, people can't accept the prize that they won. They either have to ask for a cash equivalent or just have to forfeit the prize because they can't pay the taxes on the prize that they're winning. So that does happen. He is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes. And he contributed $3,000 to charity. Determine the man's gross income, determine the man's adjusted gross income, determine the man's taxable income. Okay, so this man's gross income, so this is before any taxes, before any deductions, before anything like that. Just how much money altogether in total did this person make? So we'll circle these in red. This person's wages was $46,500. So that counts as part of their income, $46,500. They also received interest from a savings account. That counts as income. That's extra money that this person made. So that's another $1,850. Plus $15,000 from winning money on a television game show, which again, in reality, would probably be taxed in a different way. We wouldn't include that as part of the gross income. That'd be a separate category that's taxed at a different rate. But for simplification purposes, I don't know, I'm saying that kind of funny. In the interest of simplicity, we're just going to include it as just regular income. And that seems to be it. Now, this person contributed $2,300 to a tax-deferred savings plan, but that's not income. That's money going into a savings account, not money coming in as income. So this is all the income that's mentioned in the problem, and I need a calculator. Let me go grab one out of my bag. And we will add this up. So 46,500 plus 1,850 plus 15,000. And this person's gross income ends up being 63,350. All right. Part B, let's use a different color here. Part B, let's determine this man's adjusted gross income. So if you remember from the previous page, the adjusted gross income, I'm just going to abbreviate adjusted gross income, I'm just going to say that, is the gross income minus, I forgot the word that was used on the previous page, minus, that's the taxable income, minus adjustments. Let's call them adjustments, right? So minus adjustments, which would include anything that's tax deferred. Let's get this money out of here before the taxes are applied, right? And so anything that is not subjected to taxes, anything labeled tax deferred, and there's only one thing in this problem that's labeled that way, which is this $2,300. Right? It is tax deferred. That's considered an adjustment. We want to take that out of consideration. And so we're going to adjust the gross income with that adjustment. Right? And so we have our gross income, which is the $63,500. Sorry, I don't know what, I'm just making up numbers now. $63,350 minus this adjustment of $2,300. And that's going to give me, so I'll just subtract that off of that number in my calculator, $61,050. And that is the adjusted gross income. And then we are going to, before we decide how much this person owes in taxes, we need to remove any exemptions or deductions. We could either look at the standard deduction, which is given in the problem, or trying to itemize the deduction, which includes interest on home mortgages, state income tax, property taxes, charitable contributions, medical expenses exceeding 7.5% of your adjusted gross income. So again, all of those things can be deducted from your income if you want to itemize your deductions. Like I said, for me personally, I always look into it, but my itemized deductions just never add up to the standard deduction for me. But you would have to consider your personal situation before making that decision. You don't want. I mean, like, if you just want to keep it simple, then yeah, standard deduction every time. But there are definitely people in situations where itemized deductions are a better choice. So we have to make a choice here, right? When we file our taxes, and the government's not going to tell you what choice is better for you. You have to figure this out for yourself, right? Or you have to let your tax preparer determine this for you. So we have the standard deduction versus the itemized deduction. Sorry, I don't like how that looks. Let's try that again. Right. So here's a choice we have to make. Now for the standard deduction, it says in the problem here, it's $5,950 versus doing an itemized deduction. And every item that follows is part of this itemized deduction. The interest on the home mortgage, that can be deducted from what we owe for taxes. Again, it's not deducted. I should be careful how I say that. This is not being deducted from what we owe for taxes. It's being deducted from our income before taxes are being calculated. So we can subtract off our income the money that we paid for interest on our home mortgage. The $2,100 in property tax, that might include a car, a boat. Trying to think what other properties would be considered there. And $1,855 paid in state taxes, right? And $3,000 contributed to charity. So all of these are part of the itemized deduction calculation. So we have $6,500 plus $2,100 plus. Now I could do all this and find the standard deduction is a better option for me, and it will feel like a waste of time. But hey, this is your money, right? You want to get back as much money as you possibly can, or not have to pay as much. You know, you're trying to avoid paying more than you have to, right? So either you're getting a refund and you want to maximize that refund, or you're having to pay taxes, but you want to minimize how much you're paying. So you want to take the time to make this comparison, even if it's a little bit of work, right? Now, these days, like, I use an online tax preparer, which for my income level, it's free. Depending on how much you make, you might have to pay for the service. And it kind of does all this stuff for you. It's going to ask you all these questions. You fill it out. It does the itemized deductions for you and compares it to the standard and kind of lets you know, hey, given your situation, you're better off taking this option or that option. So what is this going to add up to? This will be $6,500 plus $2,100 plus $1,855 plus $3,000. It's going to be $13,455. And that's quite a bit more than the standard deduction. So this is our best choice. Let me try that one more time. This is going to be our best choice here, itemizing it. So we'll take the itemized deduction. Of course, when you do that, you have to provide the documents, right? You'll have a document that says, here's how much you paid in mortgage interest, here's how much you paid in property taxes, here's how much you paid in your state income tax. All those documents have to be provided to show that these indeed were your costs, right? If you're going to take a deduction on your healthcare costs, you have to give all the medical bills that you paid and show that as proof in order to take that deduction. It's a little more work, but again, it's going to save you money. So we'll take the itemized deduction. So we're going to take the adjusted gross income, so the result from Part B, minus the itemized deduction, because that's better for us than the standard deduction. If this was lower, then I would take the standard deduction, and I'd subtract $5,950 from this. But the itemized is higher, so I subtract that one instead. Minus, don't forget, there was an exemption up here, right? We have this exemption up here, which I didn't include in the itemized deduction because it was going to be an exemption either way. It's nondescript. It's a personal exemption of $3,800. That also gets subtracted off of our income. and that's going to leave me with my taxable income. So whatever I get here is how much is going to get, how do I want to say this? Whatever dollar amount I have here is what my tax will be based on. I hope I said that right. That sounded kind of funny after I said it. So 13,455 minus 3,800. So I get 43,795. So when the federal government is trying to figure out how much I owe in taxes, it's not based on the 61,000, it's not based on the 63,000. They're going to say, we're going to consider your net income to be 43,795, and we're going to calculate your tax based on that value. That's going to determine your tax bracket. That's going to determine how much you owe in taxes, is the 43,795. Because they're trying to be fair in deciding, given your situation, what's fair for you to pay in taxes, right? The gross income is not always the best representation of what's fair for you to have to pay. It wants to take into account things that have happened in your life, right? How much you're having to pay in interest rate, how much you're having to pay for property taxes and other taxes, in order to give you a fair assessment of what you should pay in federal income tax. All right. Okay, so now that we've determined our taxable income, not our gross income, but we've whittled it down to how much, I'm having trouble using words here. We've determined how much of our income is going to be taxed. Right? Now we have to determine how much taxes we owe. And again, the tax rate is not a clear cut, you just pay this flat percent. Maybe it should be, right? But what we have here is, I think, what is called a progressive tax rate, which is, it takes into account how much money you make, and it tries to be a little easier on people that haven't made as much, and asking a little bit more of people who are making a lot of money, right? So here we see, again, the different options for filing. So there's single, unmarried, divorced, or legally separated. You're considered single. You can do married filing separately, as I mentioned earlier. You can do married filing jointly, so you together as a married couple file one tax return instead of two separate ones. And you can do head of household, which again, I'm not clear exactly what that, I guess it says up here. Unmarried and paying more than half the cost supporting a child or parent. Right? And then it breaks down your tax rate based on how much money you've made. So the first $9,275 you make for that year will be taxed at 10%. So that amount, that way if you're making less than $9,275, you're just paying 10% of your income in tax, and it keeps that tax rate kind of low. If you go above that amount, from $9,276 to $37,650, that region, you're going to pay 15% in taxes. So you still pay 10% for the first $9,275, but anything after that, up to $37,650, you're going to pay 15% of that in taxes. Again, this is assuming you're single. You're filing as a single. If you end up making more than $37,650, then anything above $30,650 up to $91,150, that amount, anything in that range will get taxed at 25%. Right? So if you're making less than $37,000, you never hit that 25% mark. You're not paying 25% in taxes for anything. You're paying 10% for the first $9,275 and then just 15% on everything else. But if you go above $37,650, anything above that is going to hit that 25% tax. And you pay 25% of anything above the $37,650. Now that's kind of where I'm at. That's the range I'm in. If I was fortunate enough to be making more than $91,000, $91,150 to be precise, anything above that, the tax rate goes up a little bit more. It's now 28% for any amount you make above that amount, right? And so on and so forth. So I'm not going to go the rest of the way there. All right. Now notice this is a different problem. evidently, because the standard deduction is different than it was in the previous problem we were looking at. Right? It's $6,300. If you're married filing separately, notice that follows the same trajectory up to level 3 here, right? The 25% cuts out a little bit earlier if you're married filing separately, because I think the assumption is if you're filing separately, both you and your spouse are making pretty good money. And so they're going to cut you off a little sooner, right? Instead of letting you earn up to $91,000 at the 25% rate, they're going to cut you off at $75,950. Right? Because the only reason you're filing separately is because if you put your spouse's income with yours on one return, it's going to look like a lot of money, right? And so you're filing separately to make it look like you're each making, not making less, but it just won't look like such a big pile of money. But they take that into account when they decide where the brackets are, right? And these groupings are your tax brackets, right? So if, as a married person, but if you're filing separately, if you make between $37,651 and $75,950, anything you make in that range is going to get taxed at 25%. But they're cutting you off at $75,950, right? And so on and so forth. If you're married filing jointly, well then, again, they understand they're considering two people's income at the same time. So notice the cutoffs are about double what they are over here, right? $9,275, this is double that amount. $37,650, this is double that amount. So that's how that works. And then head of household, again, adjusted a little bit differently because they understand you're not single living by yourself. You have people depending on you. You're taking care of somebody with your income, so they're going to be a little bit easier on you. I guess, I don't know. Yeah, they're being a little bit easier on you because they're letting this go up higher. So you get to be taxed at this lower rate a little bit longer, right? Instead of getting cut off at $9,275, they're letting it run up to $13,250. So you'll end up paying less taxes because let's say you're making $35,000 a year. More of that's going to get taxed at the 10% rate and less of it at the 15% rate than if you're filing single. The sooner it hits that 15% rate, the more money you're paying, right? So if it's hitting 15% at a lower amount, you're going to be paying 15% on more money than you are over here. Right? So I hope all that made sense. So let's keep this chart in mind as we take a look at the next example, which I guess is on the next page. So let's scoot on over here, zoom in. All right. And we'll probably have to flip back and forth. Calculate the income tax owed by a single woman with no dependents, so no kids, no elderly parents, whose gross income, adjustments, deductions, and credits are given below. So this time we won't have to, well, it looks like we might have to do some computation to figure this stuff out. Use the marginal tax rates from the table. So I guess those are called marginal tax rates. Again, I'm a math teacher. I'm not a business person. I can run the numbers on this. I can solve equations or whatever, but like as far as the economics and the terminology, I'm not very familiar with that stuff. So just full disclosure. All right. So this person made $62,000 in gross income. Adjustments of $4,000. So let's just go ahead and do this. So $62,000 minus the adjustments to get the adjusted gross income, right? So we'll minus that $4,000. That's going to give me $58,000, right? So that's step one. This is the adjusted gross income. So this is still considered gross income. Now what we're going to want to do is subtract off the deductions and the exemptions. Now, they mentioned the tax credit here, but that actually comes in later. So let's skip past that tax credit for right now. Maybe they got solar panels installed and they're getting a $500 tax credit or something like that. Now, there's a standard. So again, we have to figure out, do we want, and there's no exemptions here, so it's just deductions. Do we want the standard deduction or do we want the itemized deduction? Now, I think right away we can see we want the itemized deduction because this mortgage interest is a lot. It's $7,500. If you go back to the previous chart, sorry, I moved it off the screen there. There is an exemption. I didn't see that on the chart here, so I just didn't remember it was there. The standard deduction is $6,300. So if the itemized deduction goes higher than that, you want the itemized deduction. And right away, the mortgage interest is already higher than that. So we're going to definitely want the itemized deduction. And we're also going to use this personal exemption, which I guess just everybody gets, of $4,050. Right? So that also gets added in there. So let's add up these deductions here. So let me grab my calculator again. We have $7,500 plus $2,200 plus $2,400 plus $1,500. Now, I don't know if we need to adjust if that's 7.5% more. I don't know. Let me see. So this is $13,600. Now in the previous screen we read that you can deduct medical expenses if they're more than 7.5% of your gross income. So the gross income is $6,200. 7.5% of that is $4,000. So that's actually $1,500 is less than that. I'm assuming this is $1,500 that goes above and beyond the 7.5%. So we want to include that in the itemized deduction. But here, I'll check on that just real quick. Okay, so actually I checked Mrs. Groover's notes just to see what she intended by this. And the thought process we were using before was correct. We only want to deduct the medical expenses if it's more than 7.5% of gross income. Right? So 7.5% of, now let me see what she actually used here. I guess I'll just show you guys what I'm looking at instead of trying to hide it. The adjusted gross income. So we want to use the adjusted gross income for that. I want to make sure I get this right because you have to make sure you follow the same process on the homework. You know, whether we use the adjusted or the original gross income, we're going to come to the same conclusion either way. So it kind of doesn't matter, but let's make sure we're using the right number because there might be some homework problems where they make it matter, where if you use the wrong one, you get the wrong idea, you get the wrong conclusion. So remember how we do a percent of a number. You convert this to decimal form. We talked about this in 8.1, I believe. And then you multiply. Right? And then we're going to get, so I actually used the wrong one before, so 58,000 times 0.075, and we get 4,350. So we can deduct any medical expenses above 4,350. So if we had $5,000 in medical expenses, we could deduct $650 off of our adjusted gross income to account for the especially large medical expenses that we had. But it has to go above 7.5% of your adjusted gross income. For this person, that would be $4,350. So if her medical expenses had gone above that, she would be able to deduct the medical expenses above and beyond that $4,350. But her medical expenses, she must have had a good year, not a lot of medical bills, was only $1,500. So we actually don't get to include that. So let's recompute this. We have 7,500 plus 2,200 plus 2,400. And that's going to give us an itemized deduction of $12,100. Still better than the standard deduction. So we should definitely take the itemized deduction in this case. So for step 2, to get the taxable income, we will subtract the itemized deduction and also subtract the personal exemption of $4,050. And that's going to give me the taxable income on which we will decide how much she owes in taxes. So this will be taxable income here. So we have $58,000 minus $12,100 minus $4,050. And so we get $41,850. So that is this person's. I wish they gave these people names. I feel like I could do better with that. That would be this person's taxable income. Right, now that's where we kind of stopped in the previous example, but this time we actually want to determine the amount of taxes owed by this person based on that taxable income. Right, so this was the itemized deduction. Which went over here. The 4,050, remember, was on the chart right here for the personal exemption. So that's why we have that there. Now, this person's taxable income, I went the wrong way, sorry, is 41,850. Sorry, it's kind of late. This is at the end of Thanksgiving. I waited till the last minute, and I'm just kind of out of it right now, so not in the usual swing of things. All right, and then this again was just a different thing here. So here we're going to have to break this down. So the first $9,275, because this person's single, they're filing single, the first $9,275 is going to get taxed at 10%. $9,275 at 10%. Right? And then from there, from $9,276 to $37,650, that amount of her income gets taxed at 15%. So what we're going to need to do, because she went above the $37,000, her taxable income is $41,000 and something, right? So she's going to get taxed for this full amount here at 15%. But it's not 15% of $37,650, because the first $9,275 of that got taxed at 10%. So we only want the amount after that up to $37,650, which means what we actually want to do here is subtract to find out how much money is in this range. $37,650 minus $9,276. Actually, I think we might want to do $2,075. I want to subtract out that first $9,275. So make sure you subtract this one from this one to get how much money is getting taxed at in this range here. All right, and that's going to give me, so I'm using my calculator, 37,650 minus 9,275, 28,375. Switch back to the bin. 28,375. All right. So that is what gets taxed at 15%. Right? That's how much money is in that range that's getting taxed at 15%. So let's go ahead and add that to our list over here. 28,375. It's going to get taxed at 15%. And then any amount above that is going to get taxed at 25%. Right? So that's going to be the next one at 25%. To determine how much money is getting taxed at that rate, we don't do, how do I want to say here? We're not going to do like we did for this one. We're not going to say, this upper amount minus this amount here, because this person didn't make $91,400 or $150. They made $41,000, right? This is their taxable income, $41,850. That's where she stops. So we're going to subtract from her overall taxable income the $37,650, right? The upper limit from the previous tax bracket, right? And that's going to give me $41,850 minus $37,650, only $4,200 left, right? She didn't have that much more money beyond the $37,650, only $4,200. The rest of her income, which is that $4,200, is getting taxed at 25%. Right, so we stop at the limit of their overall taxable income. Now, if this person's overall taxable income was over $91,150, then we would subtract these two, the $91,150 minus the $37,650. And then in the next bracket, we would take wherever she ends up stopping at minus the $91,150 to get just the remaining amount of her salary that gets taxed at the 28%, right? But again, she didn't make it that far, so we're going to stop in this bracket here at the 25%. All right, so it was $4,200, right? It wasn't that much. All right. So again, just like we did over here, to calculate these, I guess I'll just do these down here. 10%, we want to convert that to decimal form, and then multiply. Right? So 10% of 9,275, that's 0.10 times 9,275. 15%, that's 0.15. I guess I could put zeros in front of these. That's really funny. It just got worse every time I tried to fix it. Okay, there we go. Times 28,375. And then 25%, 0.25, times 4,200. So I'll do each of these in my calculator. You really could do all of them at once in your calculator, because what we're going to do is add all these up. I'm just kind of doing it one thing at a time, so you can just kind of follow along with the math. So 10% of 9,275 is going to be 927.5. 15% of 28,375 is going to be $4,256. $4,256 and 25 cents. And then 0.25, that's really a quarter, which is, you just divide by 4. I'm being lazy here. You get 1,050. And then we add all that up, and that's how much tax this person owes, which is kind of a lot of money. I'm glad this doesn't happen to me. 5, and we get $6,233. Let's try those threes again. And 75 cents. So this is how much she would owe in taxes at the end of the year. Now, you might say that is a really big tax bill, which it is, but you shouldn't have to pay that much because you should have already paid this, right? Because every time you're getting a paycheck, the government should be keeping a portion of that to go towards your tax bill. And ideally, they try to calculate how much to take out each month or each paycheck if you get paid bi-weekly or whatever, so that by the end of the year, you have it covered, right? So hopefully, they've taken out $500 a month from my taxes, right? So at the end of the year, I've paid $6,000 already. I would just owe another $233.75, right? If that's what they did. So this is why when you get a job, they have you fill out that W-4 form so they can try to estimate how much you're going to owe in taxes, and then they take out taxes based on that information, and they're trying their best to match up to what you're going to end up having to pay based on what they think you're going to make and how many dependents you have and all that stuff. And then hopefully by the end of the year, what they've taken out matches what you're going to owe, and you won't have to pay that much more. Or maybe you overpaid slightly and you get a little bit of a refund, right? That's kind of what you hope for. So if this person had paid no taxes throughout the entire year, then they're going to have this big tax bill on their hands, and hopefully they've been holding some money back to pay for it in anticipation. All right, so I was just double checking to make sure I'm on track with what Mrs. Groover was getting on her notes, and we are, but I did forget, and I'm glad I double checked, that we have a tax credit that now gets applied, right? So this $500 tax credit, once you've calculated how much taxes you owe, we subtract the tax credits off of the amount that you owe to get the net amount that you have to pay, right? And so $500 tax credit, we will subtract that off of this, and we end up with, so minus $500, we get $5,733.75. So that is how much taxes she will owe, taking into account that tax credit, which I admittedly forgot about. Alright, so I'm sorry this video is already, at least the recording I'm doing right now, I'm at the 50-minute mark. I don't plan to do much editing, so I apologize for how long I'm talking about different things. Hopefully you're finding it a little bit interesting, because this will be your reality in the next 5 or 10 years when you kind of move out and you're on your own and you have to start paying taxes and stuff like that. So calculate the income tax owed by unmarried head of household with 2 dependents whose gross income, adjustments, deductions, and credits are given. Use the marginal tax rates from the table. So unmarried head of household with 2 dependent children. Gross income $66,000. No adjustments. So the adjusted gross income, we subtract nothing off. The adjusted gross income, let's try that again. The adjusted gross income is still going to be $66,000 minus, since there's no adjustments, minus 0, which is still $66,000. Deductions, $31,549 in state taxes. My goodness, that is a lot of. That feels like a typo. Wow, I mean, that is a huge amount to pay in state taxes. I really feel like I want to check to make sure that we got that right here. So, yeah, that is a major typo. So if you look here at the solutions, right here, deductions, it's not 31,549. It's 3,159. So that 4 was unintentional. It was just a mistake. So let's scrub that 4 out so that we can be on track with Mrs. Groover's notes. Because that's. I mean, this person only made $66,000. This would be more. This would be almost half of the money that they made just for state taxes. That would be ridiculous. So that's why I kind of was hesitant there. And then a theft loss. So I assume that's tax deductible. Interestingly enough, I didn't know that. I've never had to claim something like that, thankfully. All right, and so we'll add those together. We get $7,159. Again, this would be our itemized deduction, which is better than the standard deduction, which hasn't changed. It's still, it has changed. Wow, I really need to pay attention to the chart. Now you might say, wait, it's $6,300. No, for head of household, it's different. Because again, they're a little more lenient because you're taking care of other people. They go a little bit easier on you. So you get a standard deduction of $9,300, which is actually better. So in this case, and so let me make sure it's clear, we're looking at head of household here because that's what this problem said. This is head of household. So that's the column we want to look under. This is the itemized deduction. The standard deduction is $9,300. This is better, right? This is a better deal for us, so we're going to go with this one. We're not going to use this one. So $66,000 minus the standard deduction minus the personal exemption, which again I was assuming was the same, but maybe I'm wrong. Let's double check. Okay, that's the one that stayed the same all the way across. It's still $4,050. And so we'll subtract that off here to get our taxable income, right? So $66,000 minus $9,300 minus $4,050, and we get $52,650. So this is our taxable income. Thankfully, again, you won't have, now this used to be things you'd have to do by hand. When I first started paying taxes on my own, it was still on paper for the most part, so I can remember, but my taxes were simple back then because I didn't make a whole lot of money and I didn't have a house, I didn't have anything else. So, if I had to do this today, taxes would be much more of a headache, but a lot of this is automated, so you won't have to hand calculate all this, but it's not a bad idea to be able to kind of have a sense of what you should expect. That way, if there is a miscalculation in the program that you're using, you'll catch it, right? Or if there's a typo like we saw here, right, we can have an idea of that doesn't seem right. Okay, now don't let me forget this time we have a $4,000 tax credit, so we'll have to try to keep that in mind. We're going to do the same thing we did last time. Again, the numbers are different. We want to stop at 52,650, which means we're going to stop in this bracket here, 52,650, right? So we'll make it to this bracket. So that means we get taxed for the full amount in these two brackets here. The full amount here is 13,250, right? And we're going to get taxed at 10% for that amount, right? For the first $13,250 that we make. So we'll do that over here. 10% of 13,250 for head of household. The next tax bracket is taxed at 15%. Sorry, I went the wrong direction. Again, that's going to be the full amount from 13,251 to 50,400. So because this person made slightly more than that, we have to take the full amount of money in this bracket and calculate 15% of that. To get the full amount of money, to figure out how much money is in that bracket, we will subtract. I'm just going to erase that so you can see it a little bit better. So let's use a different color. We'll use red. So this amount minus this amount here. So again, I didn't know I was going to have to use this page again. But 50,400 minus the 13,250. And I should be able to do this without a calculator. So that's 250, right? So this will be 7, 4, 3. This will be 37,150, right? Because this person made all the way up past $50,400. There's $37,150 here that's going to get taxed at 15%. Right, so let's write that down. 37,150 getting taxed at 15%. The next bracket hits 25%. How much money did this person make in that bracket? Let's go back. Again, we're stopping at 52. I'm going to do it over here. 52,650. Is that how much it was? 52,650. That's right. Okay. Minus the upper end of the previous bracket, which is the $50,400. Right, and that's going to give me 50 here to 2,250. That's going to get taxed at the 25% level because that's all the money this person made in this bracket area here. Right. So 2,250. So again, since this video is running kind of long, I kind of don't want to have to write this out, but maybe I will just for good measure. 10% times 13,250. This is going to be 15% times 37,150. And this is going to be 25% times 2,250. So we'll figure out what these are equal to. This is going to be 1,325. I just know that one off the top of my head. These other two I'll just calculate on my calculator. So 37,150 times 15%, 0.15. That's going to be 5,572.5, 50 cents. And then we'll have 0.25 times 2250. And that'll be 562.5, 50 cents. And we will add all these together. So plus the 5,572.5 plus the 1,325. 7,460. Now remember, this problem says this person has two dependents, and we don't have to know what this means, but and maybe they have some other things going on, but they're getting a $4,000 tax credit. So once we figure out how much taxes we owe, we can subtract off any credits that we have, like we did in the last problem, and whatever is left is how much we have to still pay. Again, it doesn't mean you have to like write a check and send it in, or use a credit card or whatever you might do these days, because maybe you already have it covered. Because the other thing that will be taken into account here is, well, how much did the government already take out for taxes for you? And if you've already had $5,000 taken out, and you have this $4,000 credit, you have $9,000 going towards your taxes. You only owe $7,460, so you're going to get a refund in that case, right? Depending on how much money they kept out. But what you owe overall is going to be $3,460. Right? Hopefully, your paychecks have already covered that amount as they've taken out money every paycheck. But if not, you're on the hook for that. You have to pay that. All right. So I'm sorry, I'm trying to hurry here a little bit because this video is getting a little bit long. We have one last topic here, and it has to do with, as I mentioned at the beginning of the video, other things that are taken out of your paycheck in the United States anyways. This would be Social Security and Medicare. Social Security is like a retirement fund, so that when you reach a certain age of retirement, you will have a source of income, and that source of income will be the money you paid in for Social Security. Medicare is your health insurance that you get when you retire, because you'll still need medical care, and you've paid for it throughout your working career by paying into Medicare. So in addition to income tax, we are required to pay the federal government FICA, which is Federal Insurance Contributions Act, I never knew what that meant, taxes that are used for Social Security and Medicare. And these will be itemized in your paycheck. It'll say, here's how much went to Social Security, here's how much went to Medicare. Social Security provides payments to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. Medicare provides health care coverage mostly to Americans 65 and older. Now, I want to say I was just looking at my Social Security benefits the other day, and I don't know if this is true for Medicare, but for Social Security, I don't get my full benefits for that until I turn 67. So those ages might change depending on the amount of money they have and how many people they have to cover and things like that. So here's a chart. 7.65% on the first $118,500 of your income, and then 1.45% of income after that. And this is what the employee pays. So this is how much I have to pay out of my paycheck for Social Security and Medicare. Now, it looks like for these problems, we're just combining those together as one FICA tax. Matching rates paid by the employer. So with my health insurance as well that I currently have, I pay a certain premium every month, but my employer, the college, pays some on my behalf as well. In fact, where I work, the college pays a pretty good portion of my health insurance premiums. Again, it's public information, so I guess it doesn't hurt to share. But for a family, because I have a family, I have family coverage, which costs more. I'm paying like $350, $400 a month for health insurance. The college, I believe on my behalf, is paying something like $1,500. So they pay quite a bit. So overall, my premiums are about $2,000 a month, which I could not afford on my own. So thankfully, part of your benefits package is that your employer is going to pay a certain portion of your premium. I feel like it's a pretty good deal where I work. It's not so favorable other places, so that's something you kind of look at when you're applying for work is, well, how much is the health insurance? How much do I have to pay? Because that kind of helps you figure out the best job for you to take, depending on what the health insurance is. Now, it looks like for FICA, it looks like the employer matches it, right? They pay the same amount, 7.65% on the first $118,000, $118,500. Now, if you're self-employed, you have to pay both, right? You have to pay the employee rate and the employer rate because you are employing yourself, which means you're paying altogether 15.3%. That's just adding the two 7.65% together. And same thing on the wages paid in excess of $118,500. Sorry, I'm just ready for this video to be done, and I'm jumbling up my words. All right, so anyways, we're going to use this chart to figure out, we're not going to do income tax, we're just doing FICA. If you are not self-employed, right, so we're not self-employed, and we earn $150,000, what are your FICA taxes? We're just calculating our portion, I assume. I don't know, I guess I could look at Mrs. Groover's solutions to see what she's putting here. Yeah, and then the portion above. So yeah, we're just calculating our portion here. That's what Mrs. Groover has. All right. So again, it's broken into two brackets, right? Up to the first $118,500, you're paying this pretty high rate of 7.65%. Now you might say, why does it drop so much for people that are making a lot of extra money, the people that are rich? Well, the issue there is that Social Security and Medicare only is going to pay out so much benefit. And so for people making more than $118,500, they kind of top out at that point. Like, they're not going to get that much return on the money they're putting in, so they don't pay as much after that amount because they're not going to get anything back on it, basically, for their benefits. So that's kind of why the rate drops so much after that dollar amount. And for a lot of people making a lot of, like, again, not that you're rich if you're making $120,000. I mean, I don't make that much, but like in this day and age, that's still not a whole lot of money. For people in that bracket, they may still rely on Social Security and Medicare, but for like millionaires, they probably don't really even think about Social Security and Medicare, and they probably have other plans in place, better health insurance ready for when they retire or when they reach that age. And they already have their retirements figured out other ways. Like they have other retirement funds that I'm sure they're going to draw on. And Social Security is going to be a small drop in the bucket of that. So they don't want to have to pay much in Social Security if they're making a whole lot of money. So it's kind of a political thing, but that's just what it is right now. All right. Anyways, and I'm not trying to get too political about it. I'm not judging it one way or the other. I'm just trying to say from what I've read and what I've heard people say about these rates, that's the reasoning behind it from what I've heard people talk about. So for the first $118,500, since this person makes over that amount, we're going to stop there. That's going to get taxed at 7.65%. I'll just go ahead and convert that to a decimal so we can get this video over with. And then any amount above that is going to get taxed at the 1.45% rate. Right? Now, how much more money is this person making? We have to take $150,000. That's how much they made altogether, minus the top end of that bracket to figure out the excess money that's getting taxed at 1.45%. So $150,000 minus $118,500, and we get $31,500. That's the amount that's going to get taxed at the lower rate. All right, so we'll figure out what these two are equal to. Since I already have the $31,500 in my calculator, I'll do that one first. 0.0145. That gives me $456.75. Now that's for the entire year. So if you divide that by 12, it's really not that much money coming out of your paycheck, right? It's like $40 a month. It's not going to seem like too much, or at least that portion of it. I guess I forgot we have another portion that we have to add in. Right now we have the $118,500 times 0.0765. And that's going to be Okay, that's going to hurt, right? You're going to notice this. $9,065.25. All right, and then we're going to add these two together. 9,000. Make sure I write that number down correctly. Okay, so plus 456.75. And when we add these two together, we get $9,522, which is quite a bit. That's quite a bit of money. That you're looking at like $750 a month, right? Because $12,000 would be $1,000 a month. This is about 3/4 of that, so that'd be about $750 a month going towards FICA taxes, which is a pretty sizable amount. You're going to notice that. So, all right, so that concludes the video on Section 8.2. Sorry it went on a little bit too long. Please let me know if you have any questions, and I'll see you in class for the next lesson.